Welcome to Petra's Family Tax. Today we're going to talk about how to optimize the withdrawals for your retirement from a tax perspective. So one of the things that we wanted to try to do at Petra's Family Tax, which was born from our Petra's Family Wealth business, is that we wanted to try to provide great quality tax advice and try to reduce the amount of taxes over the longest period of time. One of the things we saw with many tax professionals is that it was primarily about how to reduce taxes in any given year that they were working on without taking a look at the big picture. And from a wealth perspective, taxes can be, the third, second, or even the biggest expense for families. What we wanted to try to do is try to minimize that expense to maximize the wealth for you and your family. So what we're going to do is we're going to use one of our long-term tax projection tools that will be available to anybody that would be curious and build out and show clients the impact of maybe ripping the Band-Aid off sooner or going ahead and paying taxes now, and what that impact might be taking that tax hit many years down the road. We're going to cover today a client that is a couple years away from retirement and looking at the last couple of years, whether they want to do a Roth contribution or a traditional 401k contribution, and the different tax brackets based on their withdrawals. Now, from a purely wealth perspective, you'd have to link up with our Petra's Family Wealth. From a tax side, we can make this study or help determine this study and help you and your advisor, or if you wanted to have a fully integrated plan, feel free to reach out to us and happy to share and talk through anything that might be fruitful for you and your family. So with that, let's go ahead and dive in. So what we have here is purely the long-term projected tax bracket for a married couple that's a couple years from retirement. And one thing you'll see is as they're working, they are in a higher tax bracket. So you can see here, you can see a little purple, that's the 10% tax bracket level. Green is the 12% tax bracket. And orange is where that 22%, so any bar above that 22% of that orange, those dollars will be taxed at 22%, and then anything above the blue will be taxed at the 24%. And so as we're looking at managing folks' taxes over the longer period of time, depending on their withdrawal strategy and the different types of investment accounts they have, many times we do see this kind of golden window between the moment of retirement and when people start to take Social Security, where there's usually an opportunity or a number of years where we can essentially control what tax bracket clients might be in with proper planning. So as they're working, they have some income coming into that 24% bracket. And again, they were considering contributing to a Roth or traditional. And in retirement, we have this gap year where we're drawing from other investments, either from Roths or some brokerage accounts, and it has a zero tax rate during these years. And then as time goes on and the client starts to take mandatory distributions, they get pretty darn close to coming back up to that 24% bracket. And so again, our goal at Petra's Family Tax is to try to reduce the amount of taxes over the longest period of time. And so with that, two of the strategies we could do is while they're working, because we have this lower income tax year, we can potentially switch from Roth 401k contributions to traditional, because that marginal amount for every dollar for putting into a Roth versus now putting in a traditional, you're deducting that 24% tax. But immediately at retirement, before they start taking Social Security, what we do is we start to draw from the traditional 401k or traditional IRA assets first up to and fill out that 12% bracket. So one way to look at it here is the last year that you're working, you put $100 into your traditional 401k, you deduct 24% or you get $24 back on your taxes. But then the next year, you take that same $100 out and pay 12%. You effectively, in a 12-month time frame, you made a 12% return just by controlling and planning around what makes sense for you and as you head into retirement. And the impact of making that deduction and then withdrawing into those lower tax years, it does get a little bit hard as those mandatory distributions start to come in. There's a couple different strategies you can do for charitable giving. But as far as if you were going to use all those distributions for your retirement needs, sometimes it does get hard to maintain that lower tax bracket. But just by deducting here and then withdrawing from during those lower tax years. In this scenario, it saved them a cumulative about $80,000 in taxes, which also increased their total wealth potentially of almost $500,000. That shows that power of trying to reduce the amount of taxes over the longest period of time in order to set you and your family up for success financially. So I hope you enjoyed that type of scenario, and if you are interested in doing a project with us, feel free to reach out. Happy to see how we can help you and your family. Thanks so much for your time.